Good morning, ladies and gentlemen. Today we're going to be going over the weekend deep dive where we go into what happened this last week, where we see the stock market going in the future, the bull and the bear scenario. And today you guys have the two for the price of one, me and my buddy that you guys love and enjoy. So without further ado, let's get into the video. We're first going to go over the market news, what happened this week. So Monday, not really much. You had Bowen speaking. And then Tuesday, the Big Daddy CPI report came in at 6.4% with expectation 6.2, and the market pretty much shrugged it off completely, ran up higher. Afterwards, you had some Fed members speaking. Williams not really giving much of an opinion on what he thought because he recently gave his opinion. And you had a bunch of other news. Then came Thursday, which you had initial jobless claims coming in below expectations, as is coming every single time. It never gets it right. The last one, as I call it, was kind of a fluke because they guessed lower. And then you had core PPI, which absolutely murdered. It came in at 5.4 with expectation 4.9. The month over month actually increased, showing that inflation is still entrenched in the economy. This is what producers are producing, so they're now going to pass this on to the consumer. So this is a leading indicator. So we're going to be talking about this in deep today, along with nothing really coming out on Friday. We did have Bullard speaking on Thursday, which did send the market down lower, and we're also going to talk about that. But without further ado, I'm going to turn it over to my buddy, and he's going to talk about the winners and losers for the week.
Hello, my fellow investors, and now it's my turn. So thanks for that, boy. And, well, how exactly did the market take all of this news? Because, dear Lord, was it just topsy-turvy. We're talking left, right, up, down. As you can see right now, I have the S&P 500 index open. The 5-day ended 0.52% down. And it's interesting because, well, CPI came in a lot higher than expected. They were expecting, I believe, on the 5, on like sub 6, right? And even you guys in the community post said it was going to be lower than 6.5, and it ended up being only 6.4. We covered that on the live stream. It's very, very interesting because, well, if things continue to go the way that they're going, we're probably going to see CPI begin to edge upward. And we all know the headlines when it comes to the news and CPI. Even though that's not what the Fed likes to see, CPI does make always headline news, and the market will react to it. And we just saw this right here. Now, on the 5-day, as I said, it did go down 0.52%. However, on the day, as if we're recording this, it is Friday, it actually ended up still negative at almost 0.3. And, well, it was kind of slowly going upwards toward the end of the day. However, overall on the week, yeah, 0.52% down. Now, looking into each individual sector, however, we kind of see something a little bit interesting. So now we're here, guys, on the heat map. We can see that it's a mixed bag. It really is a mixed bag. We have a lot of red, but we also have some green as well. And you know, there's just one sector here, of course, the meme sector, as I like to call it. It's a ruby today. It's usually an emerald some weeks, and some weeks it's a ruby. Pick your poison. It's just it is what it is. But nonetheless, coming now into the tech sector, guys, the biggest gainer when it came to this one was ADI, analog devices, gaining 8%. And the biggest loser was actually FIS, Fidelity National Information Services, losing 7.86% on the week. Looking now into the communications, surprisingly enough, Paramount gaining a whopping 9.73%. And the biggest loser, you know, you would think it's Disney. It did lose 2.63%. However, it actually wasn't. It was Match. It was Match losing 3.22. But you can see that this sector was definitely way more positive than negative as compared to that of, you know, the tech sector that we just saw. Looking now into the consumer cyclicals. Here, well, we do see a lot more green here. This one especially, and also in the consumer defensives as well. We do see a lot of green here. And normally, if you look at this, you're like, wow, Tesla 5.8% up, $208. Not the biggest gainer, though. In the consumer cyclicals, the biggest gainer would actually have to be NCLH gaining 8.56%. And the biggest loser would be DR Horton Inc. losing 4.27%. Looking now into the consumer defensives, definitely more green. However, nothing was really in the green, like deep in the green, I mean. From what it's looking like, guys, the biggest gainer would have to be none other than Clorox, gaining 2.07%. So really not a lot, even though, I mean, 2% is a lot, but it's not a lot in comparison to what we have seen. And the biggest loser from what it's looking like, guys, would definitely have to be the Kroger company, losing 1.79%. Looking now into the financials, here we see a lot of red. It's not surprising seeing the CPI did come out, higher inflation, likelihood of Fed increasing interest rates, banks are going to take a hit. And we do see here the financials, or at least the credit card services, losing a lot. Especially PayPal, which lost 7.6%. And by the looks of it, this is the biggest loser out of all of them. PayPal, PYPL, losing to a price of $74.66. And from what it's looking like, guys, the biggest gainer, it's actually very easy to see, would be, I've never actually seen this one, ACGL, Art Capital Group, gaining almost 5.6%, $67.81. Now coming into the healthcare sector. Very, very interesting because, well, the drug manufacturers, like the big ones, not that good overall. But you can see that even the smaller companies didn't fare too well, but they weren't as deep in the red as the big ones over here. Eli Lilly losing 4.84%. However, the biggest loser was none other than Organon, losing 10.34%. And the biggest gainer, from what it's looking like, guys, would have to be West Pharmaceutical Services, WST, gaining, take a look at that, 15.7% on the freaking week. Absolute insanity. Coming now into the industrials, a lot of red. Actually, no, sorry, a lot of green here. Sorry, my bad. It's actually a lot of green here instead. The biggest gainer, from what it's looking like, guys, would have to be actually Generac, gaining 8.67%. And the biggest loser is actually fairly easy. It would be NSC, Norfolk Southern. I wonder why. If anybody knows what's happening in Ohio, yeah, that explains why, right? Losing almost 6%, 5.96% to be exact. So not surprising that they're in the red, seeing again the Ohio oil spill. And apparently now another train derailed in Detroit or something like that. That's actually happening. So again, Norfolk Southern losing 6%, not surprising. Into the real estate sector, a lot of red here, and the biggest loser, guys, would actually have to be, well, HST, losing 6.82%, and the biggest gainer actually wasn't a lot of gainers. It really wasn't. Most of them were in the red. Honestly, like, the biggest gainer from what it's looking like would be Welltower, gaining 2.82% on the week. And now looking into the most defensive of all the sectors, we got the utility sector. There was actually a lot of green here. There wasn't really a lot of red, and the reds that there were very, very minimal. The biggest gainer, however, would be Salon Corporation, gaining 5.75%. And the biggest loser, which again, there really wasn't much, would have to be none other than CEG, losing 2.6%. And now we move into the best of all sectors, the most meme-worthy of all the sectors, if I do say so myself, the energy sector. This is a ruby. This whole entire thing is just, it's a ruby. This is nothing else for me to say. Everything here is red. This is nothing else for me to say. Everything here is blood red. Even the major oil companies, ExxonMobil and Chevron, losing a significant amount. However, I mean, I would normally say the biggest gainer, but the biggest loser would be none other, would actually have to be none other than Devon Energy, which I just made a video on, guys. Devon Energy losing 16.07%. So take a look at my video that I made on Devon Energy. I did have some positive things to say about it, especially when it comes to their outlook in their earnings report. So if their outlook actually ends up being true, which always take things with a grain of salt. Please do your own due diligence, because again, none of our videos here are financial advice. So again, please do your own due diligence. If the earnings report do seem to be true, this company losing 16.07% on the week might be a pretty decent buy. But again, please do your own due diligence, not financial advice. Check out that video, and of course, have the calculators to see what price you get or even what grade you give the company for its fundamentals. And now lastly, looking at the basic materials, we actually got a lot of red here. However, we have we had two really green ones, but out of the two really green ones, Ecolab would be the biggest gainer, gaining 11.22%. And the biggest loser would have to be, I thought it was going to be Newmont Corporation, losing 5.34%. However, it was none other than CF Industry Holdings, losing almost 9% on the week. Overall, guys, this was the week performance for the S&P 500. Kind of mixed, a couple green spots here and there. Some sectors were more green than others. overall, yeah, it was slightly leaning towards the red, which explains the negative 0.52% on the S&P 500 on the week. Anyways, guys, that pretty much does it for my part here on the video. And now I'm going to leave it up to Boy for his section of the video. So I will see you all then.
All right, so everyone, if we look at the day overall on the market was pretty mixed. You had green and red, but what's really fascinating that you really have to challenge your perception of the market is when you look at the last 4 hours. If I were to show you this graph and not tell you it's the 4-hour graph, you would be saying, well, we had a green day because almost everything in the last 4 hours was green on its 4-hour candle. And the market itself on the daily, which fascinated the daylights out of me. You had a hammer candle here. For those that don't know what a hammer is, it's literally a hammer where the full body, there's no wick towards the bottom or towards the top, depending if it's bearish or bullish. In this case, it's bearish, so you want to see the full body be very small and a very large wick, meaning that sellers were able to defeat the buyers and send the stock lower after having a significant rally. You then gap down on open and pretty much broke a lower low. So you formed a lower low from the previous week, which the previous week's low was around the 405 region. That's why we talked about in the last week in deep dive, 405 was a key level. That's where we needed to hold and advance. However, you didn't close above it. So therefore you actually had a failed breakdown. So you broke down below it, you formed a new lower low, but buyers stepped in and they were able to buy it back up, forming actually a hammer after the bearish hammer, which it just blows my mind because you rarely ever see this in any stock, especially the S&P 500, the NASDAQ or Dow, any index. This is a real rarity. And you have a gap. So any bear out there, if you're looking at this saying we have to go lower, you had every opportunity to send it lower. And you guys know we're pretty much not going to say perma bears, but we're very bearish on the long-term outlook of the market. But we also say that it doesn't matter what the stock does or the stock market does, make money doing it. So how can you make money off this play? It's pretty simple. You have a gap here. You have a gap right here at about 408 to 407. If we measure that, that is a potential, if you bought on close and when you fill the gap, that's a potential of a 0.23% profit. And NASDAQ actually has even a worse gap. This thing was absolutely bonkers crazy today. You have a doji followed previously by a hammer. I'm like, this market can't make up its damn mind of what it wants to do. But you have a gap here as well, and that gap's potential from close to here is about 0.72%. So play the gap fill, guys. It's the simplest trade in the world to play the gap fill. But where could we be going from here? I don't consider the bear flag or bull flag to be validated just because you had so much consolidation here. This flag is way too big to consider this to be a flagpole. If this is your flag, then your flagpole is about 70% of your flag, so it really doesn't define itself as a bear flag or a bull flag. So let's look at simple levels. Where does 405 come from? 405 is our April low. That's a key level that we constantly bashed our head into around the CPI data point, and that sent us lower, and now we are bouncing off of it. We've defended that level now twice. So buyers have had the opportunity to buy this 3 times. Once, twice, thrice now. So we need to see advancement in the stock. The bears had every single possible reason to send us lower. They should have, if they had the strength in them, they should have gapped down and it should have been a murder day. We should have seen 2% on the NASDAQ, should have seen at least 1% on the S&P. We saw it for about 5 minutes and then it just said, nope, we're gonna go higher. If we go into the 15-minute real quick, to just take a look at how the day kind of broke out on the S&P, you had gap down, defend 405 the whole day, digesting that area, then push up. NASDAQ, similar story, but a little more cup and handle looking. On the short term, you have what could be perceived as a cup and handle forming, so we could be heading higher. And you actually, which was fascinating, and this is something I'm really getting new into with you guys, is volume profiles. So volume profiles is just the profile, as it's implied, of the volume of that day, and then at that certain price point. So you see these nodes here is basically where a lot of volume is transacted at that price, so it gives you a distribution. Previously, we closed below value area low. Usually that means you're going to come and retest that area and go higher. And whenever you close out a value, you're going to retest that lower portion or higher portion depending on which value it is. You gap down so far away from value that you actually had to work your way back up, tackling this naked POC that's here that was back from February and pushed higher. All this should have been bearish resistance, and you did have the first rejection off here, but you just kind of just chugged along. What do we want to see from the indexes to give us a bullish scenario, and what do we want to see from the indexes to give us a bearish scenario? So it's pretty simple. You have to have continuation, and we need to reclaim the 410 region probably by Wednesday, I would say. If you haven't reclaimed 410 by Wednesday, I would expect more downside potential than upside potential, because the bulls really have a lot of opportunity to squeeze the bears like no tomorrow. We've been actually talking about this on the channel, that I foresee a bear squeeze all the way up to 425. And I honestly thought when we started pushing up here, we were going to get the bear squeeze, but then this gap down push up, it really challenged my perception of, I was questioning, are we going to get that? But I would say with a very high level of confidence, seeing how the bears couldn't actually break below 405, had a failed weekly breakdown, I see us filling the gap, taking out some shorts, squeezing up, and you actually have the potential on Tuesday or Wednesday to really squeeze all the way up to 412. You could have a massive day on Tuesday or Wednesday, especially with those value areas not being tested. So they're going to attract price to that area as you go up. For the bear scenario, it's really simple that you got to break 405 and you got to break it with momentum. But the problem I see with the bear scenario is the NASDAQ. The NASDAQ, you actually failed twice this week to break below the 50 weekly moving average, because we've talked about this thing till we're blue in the face. And you failed again today. You had every catalyst imaginable to break below this 50 weekly moving average, and you're failing. You're absolutely failing. So the bears, and my perception is, and I also want your opinion as well, do you see the bears throwing a hissy fit that we need to go lower? They're constantly saying we need to go lower, but okay, you had the opportunity, you didn't do it. So why are you bearish on this market right now? Right now, the chart is telling you that we're going to be going higher. There's a very strong upside possibility. You bounced off of your 50 weekly moving average. You're above all the moving averages on S&P. Dow Jones had one of the most beautiful bounces I have ever seen. You're in this symmetric triangle, and you're heading towards upside. You bounced off your 50 daily moving average. You're advancing. You didn't even come to test the support. So even if Dow were to break down, you still got support down here. Same with the S&P, you still got the 50 weekly moving average. So we really could see a very volatile bear squeeze come next week. If we look at the S&P, where are their stop losses going to be in place? Guys, they're going to be right here at swing point low 408. You break 408, you're probably pushing up to 410 with momentum, squeezing more bears out, because on the way down here, you had plenty of bears loading into the short positions, and you're just going to, how do they close their position? They have to become buyers. So now buyers accelerate, you get past 410, and you really could have a very big rocket ship to the upside. So just so you guys can see that we're not just all talk about this, we're actually taking positions based on what we said. We said when we were here that I see more bearish side. I was actually taking out short positions when we were going to that, and here is the evidence to that. So if we look at positions and closed, I talked about I was shorting Apple, Nvidia, NASDAQ, S&P, and then natural gas continuing to burn a hole in my pocket. So I made about $228 this week on the short positions. I actually closed them out because we closed so far below value area low. I said this is going to reverse. I'm 75% in the profit on most of the positions, somewhere at like 60%. I said that's 2 more weeks of exposure I have no desire to be exposed to, so I closed the positions on close actually. So I took out a S&P and a NASDAQ credit spread for the put side. And I'm looking to, by Wednesday, to have a nice push up, this to expire worthless, and to actually see nice continuation up higher, where I could actually load more position. I was thinking about Caterpillar or even Boeing. Those two companies kind of on my watch list to look out. I wouldn't necessarily be going into tech, but let's take a look at what tech is doing from Apple on the daily. Apple had a nice inverted hammer and then followed by the doji or a hanging man candle in reverse. So that's a good sign. You have Google continuing to hold above its 50 daily moving average. Microsoft, you're below the 50, but you had a lot of gaps. So when this thing rips right back up, there's a lot of gaps to fill. And I even may be picking up Microsoft on Tuesday, depending on how we open. I could see Microsoft retesting this 253 range, but I'd definitely be selling puts around this range for the push upside, because you had a previous bounce here. You kind of fill that gap. It's right below some of the price developments. So you're going to see a lot of people get short, or we could just rip right up on open. You got a lot of gaps to fill. Amazon is one of those I'm hesitant to, just because you have flattening volume. We really didn't see like increasing volume to the upside, and you kind of have almost like a inverted hammer. I want to see confirmation on that before I get there. Everyone's favorite stock, Netflix. You have a lot of potential to the upside here. You have a inverted hanging man candle here. You have a gap. You can easily push up, take out these shorts, get above this 9-day moving average, and try to reclaim this uptrend. I do think you may get rejected around that region, but if you keep plowing up and possibly take out this uptrend, definitely something bullish. But overall, the S&P is looking very strong from a level that we want to hold. And also, what happened the last time we were coiling like this? Oh, here you go. You had 2 doji candles on the weekly. What happened afterwards? You had an insane rally of epic proportions. We rallied about 10%. So let's take a look. Let's take half of that, 5%, right? So from where we are now on close to the area that I say the possible trap could be started is 4%. To the upper end is 6%. You have significant upside, and your downside on a percentage basis is 1.5%. That's plain simple risk to reward. It's can make 3 times as much to the upside as to the downside. And then you flip. Once you get up into this region, I'm going to be looking for shorts. I'm probably going to be loading the dang boat like no tomorrow with shorts once we get up to this 425 region and this, I would say, 325 on QQQ region. But until then, we got to look at what the chart's telling us, and we have to see. You had 2 doji candles here. You have something similar. You're forming an inside bar on an inside bar. The coil is winding up. It's going to explode. And let's take a look at the news for next week to see what could possibly catalyze us to the upside. So Monday, we really have nothing. You have a holiday, market's closed. On Tuesday, we have manufacturing PMI and the S&P Global Composite Services PMI. That could be a market mover to the upside, depending if we come in higher or lower. Then you have nothing really on Wednesday. You have Williams speaking, and the Fed minutes releasing. I take that back. You have a lot on Wednesday. You have the Fed minutes coming out, and this could be a massive market moving event, especially depending on what the voting members have said. So why do I say and put emphasis on voting members? Bullard is not a voting member, guys. His opinion does not matter in the grand scheme of things, because unless he's able to sway Jerome Powell, and Jerome Powell is mainly the person to sway the entire board, let's say, or kind of he has a lot more pull. And Williams, now that Jerome Powell listens to, is now the vice chair of the Federal Reserve after Leon Brainer is leaving. So the 2 most powerful people is who you need to listen to. Williams will be speaking after the Fed minutes release in the afternoon, so we could have a rocky start to that, but he's also like Jerome Powell. He avoids the topic. He basically said, here's my opinion. Let the data play out. The data not necessarily maybe going the way he thinks it's going or they're seeing, because they're kind of wanting to stick with this narrative that inflation's conquered, and they haven't seen their preferred metric do it. And we have initial jobless claims on Thursday, but nothing really to move the market. But on Friday, you have the Fed's preferred metric for inflation, which is core PCE and PCE. Their expectations for core PCE is 4.3 with a decrease about 0.1 year over year, and the month to month to actually increase by 0.1. So the market's already going to be pricing this in. We don't have any expectations for the year over year or month over month of the standard. If we see a decrease, or if we come in basically at the same level, I think the market is going to have a rip up. I think the market has the capability. They're gonna say PPI and CPI don't matter, that they're gonna run on this metric, or it can come in horribly. To me, I'm going to exit all my positions before Friday because I want no part of this craziness that's going to happen on Friday. And Wednesday, I think the Fed minutes are going to reflect what we already know. It's not really going to move much, but you're going to have a lot of volatility. So you really got to be careful with any positions that you have. So where are the key levels for next week? And it's a very, 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 very simple thing. You have to break this range. I'm actually going to say the range for your support is the 298.10 level, which is your 50 weekly moving average. So that is going to be your support. Your resistance on the NASDAQ is going to be 390.27 because that's your upper area of consolidation from this previous week. And your true runner target, as I would call it, is 313.68, the high from the previous 2 weeks ago on NASDAQ. The S&P, we're actually going to keep the same ranges that we had, 410, 405, 417, 76. You need to break those ranges to continuation higher. If you're anywhere near 416 by Wednesday afternoon or Wednesday morning, I'd definitely be looking for a big expansion because probably bet money on it, which I am betting money on because I'm bullish on the market, that there is a lot of shorts stop losses sitting there. And all it takes is for some algo out there to go bunk and trigger every one of those stop losses and run the market right up, and the algos will be selling into it. So guys, make sure you have proper risk management. Don't try to hold a position that's not working out. If it's not working out, you need to close it. You need to have a stop loss, and have a stop loss before you take the trade. Know where you're going to get in, know where you're going to get out, and know where you're going to have your stop loss. Because too many people let their positions go to where they're having an 80% loss that no one can recover from. Remember, your losses, you have to go further to compound them back. If you lose 20%, you need to make 40% on a trade. It's not a 1-to-1 ratio, it's a 1-to-2 ratio. So make sure you have proper risk management. That's how people blow up their accounts. And then quickly, we're going to dive into the commodities real quick, just for those that are here for the commodities as well. Oil, pretty bearish. I'm not going to sugarcoat it. You're heading towards this bottom support. You could be breaking it, which would help inflation, and the Fed would cheer it. You could bounce there, but we got to see. Silver, like we talked about, we're having the kangaroo kind of. You're in between all these SMAs. Probably once you get above $22, I'd be looking to go long on it, just because that confirms the bounce. Gold kind of scares me because it broke below the 50s. You're probably coming down to this 50 weekly EMA of 1,806 roughly. So I would like to see what it does to silver as well, because they're both correlated. And the other thing, for all the bears out there that still want to be bearish, your precious yields are forming ugly graphs. You're finding selling pressure on the yields. That's the 2-year, 5-year, 10-year, 30-year, 1 year. If the 1 year doesn't tell you a clear story, you're exhausting up here. It is clear as day that you're exhausting. Let's take a look at the dollar. What is it doing? Dollar inverted hammer on the daily. You broke below the previous range for the week. So you had a consolidation that you should have expanded out of, and you failed to break out. So now you have a failed breakup. You could be heading lower. You could be coming down to this 103.20 level, which is going to be bullish for stocks. Now, let's quickly recap and take a look at the VIX. For all those that don't know what the VIX is, it's the volatility index. You have this wedge forming here, which this is where I say that's going to be a trap, because VIX is going to come down here, probably bounce off of 1694, which it hasn't been down here probably for 3 years. And when it comes back, it's going to come back for the market with a vengeance. But you're going to get to extreme greed. I guarantee you, the fear and greed index is going to hit probably 85 when this S&P runs every bear out of the market, because they've been screaming and hollering the whole way up. What's more perfect? What will be more perfect than to run it up past the swing point here, break out, create new breakout traders, and then we head into the trap zone. And notice how the trap zone is right below the 25% point from the lows. Why do I have that here, guys? Because every bear market in history that is historically known is slightly less than 25%, but they all come around that 20 to 25% range. So that trap's getting set somewhere around here. I think 425 is right where it's going to be set, but I could be wrong. But you know, you're going to let the market tell you what it's going to do. Right now, I see more upside. I'm betting on the upside. If not, we could go lower. I'll bet on the downside. But you have more bullish volume. You have the VIX collapsing, the dollar not breaking out, yields going down. I think you have a lot more downside potential in all the other markets except the S&P, NASDAQ, and Dow Jones. So guys, throw down the comment section below, where do you think the market's going? Are you team bull or bear? And if you guys like this type of content, hit the subscribe button and the like button. It really helps us out. We try to customize it for you guys, so make sure you throw any ticker symbols that you want down below. And now we're going to get into the piece of like us debating about where we think our own mindsets of the market is. So what do you think?
So at least for me, I personally, it sucks because I still believe that the market still needs to fall, right? It's not necessarily a bearish position. It's more of just in comparison, and by the way, this is using Warren Buffett's favorite indicator, stock market to GDP, we are still very much overvalued by around 50%. So based off of that, it should go down. But the problem is that there isn't any signs of it coming back down. As you said, the bears had the opportunity several times to bring it down, but they don't. And yep. I don't know where to go from there. So it's like I see it going down. It needs to go down. All these indicators, right? They're telling me that should go down. We have overvaluation. There's still several companies out there that I'm like overvalued from a discounted free cash flow approach. Stock market to GDP is telling me that it's overvalued, yet we're not seeing it go down. So I don't know. Like I just don't know. So me personally, from a fundamental standpoint, I still think companies are overvalued and they should come down. However, at the end of the day, you know something? If it doesn't go down, just make money.
Yep.
That's really it. I don't want to be in a bearish position, right? Well, how can I say this? It's not that I am a bear. It's that no indicator's telling me that it should go up, but it's going up. Yeah, you get me? But it's going up.
Like they say, the trend is your friend till the end, and you haven't created a lower low. You would have to take out this region of 400 to make a lower low.
Now,
you have to take You have to take out the 50 weekly to be a lower low. And like we talked about, the bears have had every single opportunity. And it really comes down to something that if you look at Ray Dalio, one of the biggest hedge funds in the world, is so far underwater right now on their trade. It's probably insanity because they've been trying to short this market. And they're screaming that this market has to go down. Look at 2021, guys. That market was legendary for one thing: squeezing shorts. That market ran up because everyone tried to short it. And guess what happened? They got squeezed out, bought back in, squeezed out again, and the cycle kept going and going and going and going until you had a 30% freaking rally in the dang stock market. And that's what a short squeeze looks like. So to me, this is setting up to be that short squeeze scenario that I've been saying. And every single person that, if you're a perma bull, it's going to end the same way as in history it has every single time ended. You're going to be the foundation for that legendary bear market rally. It's not going to end differently. You're going down. You're going to make lower lows in 2023. But who cares if you're going to make the lower lows 6 months from now? Because if the stock market rallies 50% and then drops 80%, guess what? You missed out on a 50% rally that you could have shorted all the way down to 80%. You didn't make money. You lost money, and by the time that rally or that shorting opportunity comes around where it favors your side, guess what? You have no money left because you lost it trying to prove the chart right. Do you show up to be right, or do you show up to make money? The answer should be you show up to make money. You got a gap on the chart. Guess what? Play the gap fill. It's as like the simpler you can make a trade, the better. And That's not to say, like, everyone wants to say, well, how do you position during a bear market or a downturn? To be honest with you, just have stop losses. Have stop losses and invest in companies that have dividends, because one, you're just going to dollar cost average down. You're going to try accumulating 100 shares to then sell covered calls on that stock to then continue. It's basically dividends on steroids. Like, we've really been getting into like the selling the put side and then selling the call side on companies that we own. And it's just free money. It's literally free money sitting there, just selling options that will expire worthless. And what happens if you get in the money? You just roll it and just keep rolling it until it happens. Because the market doesn't move one way or another continuously. Even during a volume capitulation rally, you still have ups and downs. The last capitulation phase of it, you don't. But you can pretty much see that. That's once you get below that 200 weekly moving average, then you got to be really bearish on the whole market. And that's when you I think once we get below this moving average that's sitting all the way down here, you're probably coming out to take this low. And once you start breaking below this 200 weekly, that's when the volume capitulation, that's when you run for the exits. But until then, you're going to have stair steps, you're going to have ups and downs, you're going to have bullish opportunities to make money and bearish opportunities to make money. So stop being team bear and stop being team bull. Be team money. Just make money. And the biggest, I think, advantage we have is we're not whales. Whales can't buy the market the way we can. They can't get in and they can't get out. So you're really going to need, or they need to get in and they need to get out over a long period of time. But with this volatility, we're actually making it very difficult for big players to get into the market because their positions are massive and they can't accumulate them when you have all this volatility because it's higher risk for them. So when those big whales start to, I would say, try to get in, you'll know, you'll have a massive rally. You'll break that 25% from the lows. But I don't think you're going to see those whales get in because there's no stability in this market. All the jitteriness of the market is what's keeping them out.
On top of that, you do have a lot of indicators still that shows that we may go lower. Not just the GDP to stock market ratio. How about just the fact that inflation did tick up a little bit and the Fed might continue to raise interest rates now. And on top of that, let's be for real, guys, the Fed's also deleveraging their portfolio as well. They are just selling off assets. So on top of everything happening, you do have a lot of probability for the market to go lower. That doesn't mean that we might see, as you said, boy, a 50% increase. We might see a 50% increase and then an 80% drop for all we know. Obviously, nobody can tell the future. The matter of fact is that the market right now is not acting rational, which, it never really does. However, what we do know is that, at least from the Fed's perspective, they are still selling off assets. They are, well, after this month's inflation, they are continuing to possibly raise interest rates, and that's going to cause things to get tighter and tighter and tighter. And if the market just keeps going higher and higher and higher, and then earnings come out in the next quarter or third quarter with really, really high expectations and they miss, guess what? Now you're going to have the triple whammy. Interest rates going up, the Fed deleveraging their portfolio, and on top of that, earnings misses across the board. And we might get, I said might, again, I do not know what the market will be doing. All I know is that based off of all those scenarios, the likelihood of it going down in the long run is a lot higher than we go to all-time highs.
Yep. And also every single rally is signified by that classic 25% rally. So just be on the lookout for it, because the thing is, if we're wrong, right? Which none of us think we are, because history has repeated itself so many times. When you get up into this region, really consider taking a lot of the risk off the table. When you take the risk off the table, there's nothing better than sitting on your hands and waiting for that opportunity to come to you. You don't have to trade every day. You don't have to trade every week. You don't have to trade every month. All you have to do is make money. If you wait a month for a perfect trade to show up, and that trade, you can go a little more size into it and then have it work out for you with proper risk management, That's all you need to do. You only need to compound your portfolio 14% year over year to beat the S&P in the long run. And that should be everyone's goal. Beat the S&P 500 every single year. Meaning if the S&P drops 50% and you did zero because you sat on your hands all year long, congratulations, you beat the S&P 500.
And by the way, that doesn't mean that you should sit on your hands. If the S&P 500 falls, you should be buying more companies based on your conviction, of course, using a fundamental perspective or a technical analysis perspective.
And really, when you get that volume capitulation rally fall, it really don't matter what you buy because it's going to just go, well, it matters what you buy if it's a Fortune 500 company. But if you're buying the Googles, the Nvidias, the tech companies on the bottom where they're going for 50% off evaluations, or dividend companies are going probably 30-40% off evaluations, it is the greatest time ever to buy. So you just have to sit on your hands kind of if you want to have a risk off. And when those companies fall, take the risk, but have proper risk management. Have conviction, like you said, in what you're buying. Ask yourself, why am I buying this? If it's just because you want to trade something, smack yourself and move on, because you're not buying it for the right reasons. You're buying it just to buy it. Unless you have proper analysis and if it's technical or fundamental, have a reason behind it and have a plan behind it. If you're buying it to dollar cost average down because you've been buying it, that's a plan. But buying a company just because it went one way or another without having fundamentals or conviction behind what you're doing is going to blow your portfolio up. With that, guys, I think we're going to conclude it here. Drop any comments, questions you have down below, ticker requests. As always, we love doing this weekend deep dives. And also in the comment section below, tell us if you like this format of weekend deep dive to having both of us where we can share both of our opinions. Do you like it separate? We want to see what your thoughts are on this style of weekend deep dive. And I'll turn it over to you for any final thoughts.
Yeah, as you said, this will pretty much do it. Like if you like, comment, subscribe, guys. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. And yeah, please tell us if you like this format. Right now, we're going on to like 47 minutes of recording. Might be a little bit long, but I'm going to try to segment it out on YouTube just so that way, if you guys want to go to a specific chapter, you guys can go to that. If you guys would like it shorter, tell us. Guys would like it this length, have it like a kind of like an informal, or I guess kind of semi-formal conversation, then we could do that too. Or if you guys just want to have like a back-to-back just conversation between me and him, we could do that as well. But yeah, just give us feedback. Tell us what you like, tell us what you don't like, etc., etc., etc. I actually personally like this kind of format, but we'll see what you guys like and we'll adjust to that. But anyways, guys, that pretty much does it for this video. As I said, like if you like, comment, subscribe. And with that said, peace out, and we'll see you all in the next stock market update video.